Economic data released this week shows that more jobs were created in the first 3 months of this year, but consumers should brace themselves for another high petrol price next month. Stats SA released data that shows that there were 56,000 jobs created between the months of January and March this year. The Department of Energy is expected to release the petrol price figures for July later today.
In the first 3 months of this year, the manufacturing sector added 9,000 new jobs. The financial services sector created 4,000 new jobs, while construction employed 12,000 people. This gain is despite overall economic output shrinking by 2.2% during the same period. But there were job losses in retail, mining and transport sectors. April Producer Price Index recorded an increase of 4.4% from 3.7% in March. An increase in the PPI can result in a spike in consumer price inflation, which could mean higher food prices. The rand has also been on a rougher ride. It fell by over 1% in early trade as the oil price and US dollar strengthened. On Thursday, it briefly broke through the 14 rands mark amid emerging market rout. On the other hand, the Automobile Association says the average rand-US dollar exchange rate used to calculate the basic fuel price has slipped in a straight line since the beginning of June. Global oil prices and the rand-dollar exchange rate are the two primary factors which influence local fuel prices on a monthly basis. The AA says it expects the pump price of petrol and diesel respectively to rise by around 26 cents and 24 cents a litre, while illuminating paraffin is set to cost 20 cents more per litre. But the AA warns that any uptick in oil prices could have serious implications for South Africans if the rand continues to slide. Oil prices surged to their highest level in more than 3 years on Thursday as the number and volume of supply outages continues to rise. The odds of a significant shortfall in supply are also growing by the day. M3 money supply growth eased to 5.7% in May, weaker than the market's forecast of 6.1%. Growth in the private sector credit extension also decelerated to 4.6%, which is lower than the consensus forecast of 4.9%. Slower credit growth was due to persistent weakness in corporate demand, while household demand continued to improve gradually. Nedbank analysts say the figures suggest that the economy is struggling to recover following a contraction in the first quarter. Diabo Seto, SABC News, Johannesburg.